Hey, it's Dan Morales. This is Homebuyer Radio. This is episode number 163, I believe. You can tell we've been way too busy lately. Hard to keep up with the episode numbers, and in all honesty, this is definitely a labor of love. Just to be able to make sure that we keep on top of the podcast and are hopefully putting out content that you guys find, is enjoyable and, adds value to you as you kind of get ready to go through this home buying process. There's so many moving parts to the mortgage process. It is really important that you have a good, competent lender that you're working with that knows what they're doing and that they can slow down enough to take the time to help you understand the process. I always tell people, the hardest part of what I do for a living is trying to explain a mortgage process that oftentimes is illogical and doesn't make sense. Sometimes, clients have difficulty understanding why we ask for certain documents or, why we go through the process the way we do. In all honesty, I oftentimes find myself telling clients, I get it. Like, I get the frustration. It doesn't always make sense, but in all honesty, you have to do what you got to do to be able to get the loan approved for a client and make sure that you take good care of them. So I understand, where you can have some frustration as part of this process. Well, this week, what I want to talk about is I want to start to talk about the 4 C's of credit. Oftentimes you might hear this term, where there's these 4 C's of credit. They are, cash, credit, collateral, and capacity. Those are what are known as the 4 C's of credit. Now, oftentimes you can get a mortgage approved and still be weak in one of those areas. But when you get to the point where you're weak in maybe 2 of those 4 areas, you start to run the risk of having a loan that may not be able to be done. So this week, what I want to talk about is I want to talk about the cash portion of the 4 C's. So when you talk about the cash portion, that really has to do with how much cash are you putting down into the transaction and how much cash do you have as cash reserves to fall back on after you've closed the deal, okay? So cash down payment, of course, is going to be what are you putting down into the deal? Where is that cash coming from? Is that cash coming from money that you saved? Is it coming from, a gift? Is it coming from a loan against a 401k or, some other secured asset that you can use? Where is that cash down payment coming from? How much is it that you're putting towards the deal? And then the second, kind of part of that is how much cash do you have to fall back on after you've made your down payment and you've covered closing costs and stuff like that? How much cash is left over? Now, normally when it comes to mortgages, cash reserves are measured by, how many months of a monthly payment do you have left after you've closed the deal, okay? So let's just say you're buying a new house and you've got to have, let's just say, $20,000 for your down payment and closing costs and stuff like that. And the monthly payment on your new mortgage is going to be, let's just say, $1,000 a month, okay? Well, if the lender is verified that you have $30,000, that means that, $20,000 is going to be used to cover your down payment and closing cost, and you're going to have $10,000 left over after you've closed, and your monthly payment's $1,000 per month. That means that you have 10 months worth of payment reserves. Now, that's considered a really good number of payment reserves, right? Oftentimes, folks have, maybe 1 month, maybe they don't even have 1 month of payment reserves after they've closed on the purchase of their house. By the time they've made their down payment and closing cost or they paid those things, maybe they have less than 1 month. That's not necessarily considered a really strong factor. That's actually probably a risk factor as part of what you're doing. Generally, 2 months is considered a good thing. And if you have more than 2 months, that's even better. The more you can show it in cash reserves after closing, the better, because then that represents less risk to a lender. Same thing is true with down payment. The more money you can put down into a transaction, the less risk to a lender, and that is a positive offset. So, those are, parts of that cash component of the 4 C's of credit. The more cash you've got into the deal, the better, the risk to the lender. The more cash you have to fall back on, the better the risk to the lender. And then the other thing that, of course, we're going to look at is where is that money coming from? Now, if you're a client that has been able to save all of your own down payment and closing costs and have cash reserves and you saved all of that on your own, that is a good, strong, positive factor, right? If you had to get the money as a gift from a family member because you don't have any savings or you have no history of saving money, that can be, it's still, you still have a down payment, but that's not, the strongest position to come in, right? Because oftentimes you're getting that gift just to get you across the finish line, which typically means you oftentimes may not have a large number of months of cash reserves as part of what you're doing. So that is just one of the components that you look at, right? So you got cash that's going into it. You have collateral, you have capacity, and you have credit. So that's the cash portion that we talked about this week. We're going to talk about the other three in the weeks to come in just kind of a quick high-level flyby, if you will, so you can start to understand some of the things that lenders look at when they go through the process of approving a mortgage. Hey, I'm Dan Morales, America's Mortgage Man. My NMLS number is 709729. Phone number is 616-931-4629. You can find me online at danmorales.com. DANMORALEZ.com. And of course, North Point Bank is an equal housing lender. Have a great day.